Friends, thank you for being here today. What if I told you that on December 18th, 2025, Canada's financial regulator just told the country's biggest banks, do not lend money in 2026, not because the banks are weak, not because borrowers don't exist, but because they are expecting something catastrophic to arrive in the next 6 months and they want every dollar locked in the vault when it does. This is not speculation. This is policy. And the number at the center of this decision is so staggering that most people will hear it and move on without grasping what it actually means. The Office of the Superintendent of Financial Institutions, OSFI, has frozen approximately $60 billion in capital. $60 billion that could be loaned to small businesses, to homeowners trying to refinance, to families trying to stay afloat. Instead, that money is now sitting behind a regulatory padlock with no clear date for release. And the reason they are doing this tells you everything you need to know about what they see coming in 2026. This is not a policy adjustment. This is a vote of no confidence in the Canadian economy, written in the language of capital ratios and stability buffers. Let me show you what actually happened. The decision centers on something called the Domestic Stability Buffer, the DSB. Think of it as a mandatory savings account that regulators force banks to maintain. It is measured as a percentage of what the banks call risk-weighted assets. Essentially, the riskier the loan, the more cash the bank must hold in reserve against it. On December 18th, OSFE announced they would keep this buffer at 3.5%, the highest it has ever been. Now, to most people, that sounds like technical jargon, a percentage point here or there. But here is what makes this decision so extraordinary and so alarming. In every previous economic slowdown, when growth stalls and businesses struggle, regulators do the opposite. They lower the buffer, they free up capital, they encourage banks to lend, to keep money flowing through the system, to prevent the economy from seizing up entirely. It is standard operating procedure. It is what you do when you are trying to avoid a recession. OSFI did not do that. They kept the buffer maxed out. They looked at a slowing economy and said, we need the banks to hold even more cash, not less. They are preparing for impact while telling you the flight is smooth. Let me be precise about what this means in practical terms. Canada's 6 largest banks, the institutions that control the vast majority of lending in this country, are now required to hold that $60 billion in reserve, not as loans, not as investments, as a cushion against losses they expect to materialize. It is a war chest for a battle the regulator sees on the horizon but has not yet named publicly. Imagine a fire department filling their trucks with water, parking them at the station, and refusing to spray a single drop on a house that is currently burning because they are saving it for a bigger fire they see coming. That is the logic here. That is what this decision reveals about their actual expectations for 2026. Now, you might be thinking, maybe they are just being cautious. Maybe this is standard risk management. Let me show you why that explanation does not hold up. To understand why OSFI made this move, we need to go back to the origin of the pressure building in the system right now. This story does not start in December 2025. It starts in 2020 and 2021 during the pandemic, when the Bank of Canada dropped interest rates to near zero and the federal government flooded the economy with emergency support. Mortgage rates hit historic lows. You could lock in a 5-year fixed mortgage at 1.5%, 1.5. For context, that is lower than inflation, meaning you were effectively being paid to borrow money. Hundreds of thousands of Canadians did exactly that. They stretched to buy homes. They maxed out their borrowing capacity because the payments were manageable at those rates. But here is the part they never put in the official reports. Those mortgages were not permanent. They were 5-year terms, and 2026 is the year they expire. Right now, in real time, we are entering the peak renewal period for those COVID mortgages. And when those borrowers go to renew, they are not getting 1.5% anymore. They are getting 4.5%, 5%. Some are seeing 5.5. That means their mortgage payment, the single largest expense most households have, is about to jump 30 to 50% overnight. Not over years, not gradually, in a single renewal meeting. This is vanishing in real time. OSFE knows these defaults will not show up immediately. Borrowers will try to make it work. They will cut spending. They will drain savings. They will max out credit cards. But the math does not work for everyone. The regulator knows that 6 months after these renewals hit, the delinquencies will start appearing, late payments, missed payments, defaults. And when that wave crashes into the bank's balance sheets in late 2026, they want those $60 billion sitting there ready to absorb the losses. This is not theoretical. This is observable. OSFI's own decision document explicitly cites elevated household indebtedness and uncertainty in housing as the primary drivers of their decision. They are not speculating. They are reading the data and seeing a mathematical inevitability. The households that borrowed at 1.5% and are about to renew at 5% are not going to magically find an extra $1,000 a month in their budget. The money does not exist. The defaults are baked in. The only question is how many and how fast. Now, let me show you the second crack in the foundation, the one that makes this even more urgent. While the mortgage renewal crisis is the headline risk, there is another layer of stress building beneath it that most analysts tend to miss. OSFI's decision also references deteriorating credit quality in corporate lending and rising consumer delinquencies. Translation: it is not just mortgages. Credit card defaults are ticking up. Auto loan delinquencies are rising. Small business lines of credit are being drawn down to the limit because cash flow has dried up. The stress is spreading. Here is what that looks like on the ground. Right now, Canadian banks report strong capital positions. Their CET1 ratios, the measure of core capital strength, average around 13.6%. On paper, they look rock solid, but that number is backward looking. It reflects the loans that have already been made and are currently performing. It does not yet reflect the loans that are about to go bad. OSFE is looking at the same data the banks are looking at, but they are adding a time lag. They know that when a borrower misses their first payment, it takes months before that loan is classified as delinquent. It takes even longer before it is written off as a loss. The crack appears before the structure collapses. And right now, OSFE is seeing the crack. This is where the countdown quietly began. If OSFI lowers the buffer now, what happens? Banks take that freed up capital and lend it out, chasing yield, trying to hit quarterly earnings targets. They make loans to businesses that are already on the edge, loans that have maybe a 60 or 70% chance of being repaid instead of 90%. And when those businesses fail in 6 months, the losses are even larger. By keeping the buffer high, OSFI is forcing the banks to be picky. They are restricting the supply of credit deliberately, not to help the economy, but to protect the banks from their own optimism. But that is not the part that scares me, because what comes next is worse. When capital is expensive, when banks are forced to hoard reserves, they do not announce it publicly. They do not hold a press conference and say, "We are cutting lending." Instead, they tighten standards informally, quietly. You walk into a bank to refinance your mortgage, and suddenly the appraisal comes in lower than expected. Your small business applies for a credit line, And the approval that used to take 2 weeks now takes 2 months and then comes back declined due to market conditions. You do not get rejected because of your credit score. You get rejected because the bank is conserving capital for the storm they see coming. This is the mechanism hiding in plain sight. The regulator fears a recession, so they force banks to restrict lending. The restricted lending starves businesses of cash flow. Businesses fail. Jobs disappear. The recession arrives. It becomes a self-fulfilling prophecy, except the regulator will frame it as prudent risk management. They will say they protected the financial system, and technically they will be right. The banks will survive, but the businesses and households caught in the credit freeze will not. Let me show you what actually happened in the last credit crunch, because this pattern is not new. In 2008, in the lead up to the financial crisis, regulators and banks kept insisting everything was fine right up until the moment it was not. The language was identical: strong capital positions, robust risk management, prudent lending standards. And then Lehman Brothers collapsed, and within weeks, credit markets froze entirely. Not because banks did not have money, but because they did not trust each other and they did not trust the borrowers. Fear became the dominant variable, and once fear takes over, rational decision-making evaporates. Every loan becomes too risky. Every borrower becomes a potential default. The system locks up. OSFI is trying to prevent that freeze by prepositioning the cushion. But here is the paradox. The act of building the cushion creates the very conditions they are afraid of. By locking up $60 billion, they are removing $60 billion of potential lending from the economy. That is $60 billion that will not go to payroll, to inventory, to expansion, to keeping the lights on. And when businesses do not get that capital, some of them will fail, who might have survived if the money had been available. This is where the first domino falls. Now, you might be wondering, if this is so damaging, why would the banks go along with it? Why would they agree to lock up their own capital? The answer is simple, and it reveals the unspoken bargain at the heart of this decision. The buffer gives the banks cover. If they are forced by regulation to hold excess capital, they can turn to their shareholders and say, "We would love to do buybacks. We would love to increase dividends, but OSFI will not let us." It is a defensive crouch. It protects management from activist investors. It protects the dividend, which is sacred to Canadian bank shareholders. And it shifts the blame for restricted lending away from the banks and onto the regulator. It is a shield, and both sides benefit from holding it up. But here is where everything changes, because while the banks and the regulator are playing this careful game of risk management and blame shifting, the real economy is about to collide with a force that does not care about capital ratios or regulatory buffers. And that force is time. The mortgage renewals are not waiting for OSFE to feel comfortable. They are arriving on schedule every single month, hundreds of millions of dollars in higher payments hitting households that are already stretched to the limit. And this part has already begun. The data forces one conclusion. When you map out the mortgage renewal schedule for 2026, what you see is not a gradual increase in payment shock. What you see is a tsunami arriving in waves, each one larger than the last, with the peak hitting between March and August. Let me show you the exact mechanism that is about to break. Here is how a mortgage renewal actually works, and why the system we built over the past 2 decades has created a trap that most borrowers do not even realize they are in. In Canada, unlike the United States, your mortgage is not locked in for 30 years. The typical structure is a 25-year amortization, but you renew the rate every 5 years. That renewal is not optional. It is not something you can delay or negotiate around. When your term expires, you either renew at the current market rate or you pay off the entire balance immediately. For most households, paying off the balance is impossible, which means they are forced to accept whatever rate the bank offers. They have zero leverage, zero alternatives. They are price takers in the purest sense. Now, think about what that means when rates have gone from 1.5% to 5%. A household that borrowed $500,000 at 1.5% was paying roughly $2,100 a month, manageable for a household earning $120,000 a year. Tight but doable. That same mortgage, renewed at 5%, jumps to $3,000 a month, an extra $900 every month after tax. That is $10,800 a year in additional housing costs. And here is the part nobody expects. There is no grace period. The new payment starts immediately. The first payment at the new rate is due 30 days after renewal. No ramp up, no adjustment period. The math just changes, and you either find the money or you default. Let me be precise about the scale. According to the most recent data from the Bank of Canada, approximately $300 billion in mortgages are up for renewal in 2026. $300 billion. That is not the number of households. That is the dollar value of debt that is repricing. And the average rate increase these borrowers will face is approximately 3 percentage points. Some will be higher, some will be slightly lower, but 3% is the middle of the curve. Now do the math. 3% of $300 billion is $9 billion. That is $9 billion in additional annual payments being extracted from household budgets in a single year. $9 billion that was being spent on groceries, on car payments, on vacations, on small business services. That money is now going to the banks. It is being pulled out of the real economy and redirected to interest payments. But that is not the real problem, because what comes next is worse. That $9 billion does not just disappear from household spending, it cascades. The family that was spending $300 a month at local restaurants now spends $100. The restaurant sees revenue drop 30%. They lay off 2 servers. Those servers cut their own spending. The mechanic shop they used to visit loses business. The mechanic cuts hours for his apprentice. The apprentice stops paying his car loan. The auto finance company sees delinquencies rise. And 6 months later, when they report earnings, the headline is Consumer Credit Stress Spreading. But the origin of that stress is not some abstract economic cycle. It is the mortgage renewal that happened in March. This is where the cascade becomes unstoppable, because we are not talking about a one-time adjustment. These renewals are happening every single month throughout 2026. In January, $20 billion in mortgages renew. In February, another $25 billion. In March, $30 billion. The peak months are April through July, when approximately $120 billion in mortgages reprice. $120 billion moving from low rates to high rates in a 4-month window. This is not a scenario the system can absorb smoothly. This is a structural break. And here is where the clock actually starts. OSFI made their decision on December 18th. The first major wave of renewals hits in March 2026. That gives borrowers roughly 90 days from the policy announcement to the payment shock. 90 days to find an extra $1,000 a month in their budget. 90 days to cut expenses, to negotiate with creditors, to figure out how to make the math work. For some households, it will work. They will cut discretionary spending. They will drain the emergency fund. They will make it through. But for others, the math simply does not close. And those are the households OSFI is preparing for. Now, let me show you why the regulator is specifically worried about late 2026, not early 2026, because this is the part even analysts tend to miss. When a borrower renews their mortgage in March and sees their payment jump, they do not default in April. They fight. Human beings are hardwired to believe tomorrow will look like yesterday. They assume it is temporary. They assume they will get a raise or a bonus or something will change. They make the payment in April by putting it on a credit card. They make the payment in May by skipping the car insurance. They make the payment in June by borrowing from family. But by September, the credit card is maxed. The insurance lapsed. The family cannot help anymore. And that is when the missed payment happens. That is when the call from the bank comes. That is when the default appears in the data. OSFI knows this timeline. They have seen it before. They know there is a 6-month lag between the payment shock and the default wave, which means the renewals happening in March 2026 will show up as defaults in September 2026. The renewals in April will hit in October. The peak default period will be Q4 2026 and Q1 2027. And that is why the buffer is staying high. They are not protecting against what is happening now. They are protecting against what is locked in to happen 9 months from now. This part is non-negotiable. The defaults are already scheduled. They are written into the renewal calendar. The only variable is magnitude. How many households are truly on the edge? How many will make it through versus how many will break? And OSFI has clearly decided that the number is large enough to justify freezing $60 billion in capital. But let me show you what actually makes this worse than 2008, because the comparison keeps getting made and it is not quite accurate. In 2008, the problem was asset quality. The mortgages themselves were bad from the beginning. Subprime, liar loans, no documentation, people who should never have qualified. The asset was rotten at origination. This time, that is not the problem. The mortgages written in 2021 were solid. The borrowers qualified. They had down payments. They had good credit. The asset quality was fine. The problem is not the borrower. The problem is the rate. The structure itself is broken. Here is the simple logic that does not apply. In a normal economy, when rates rise, it is because growth is strong and inflation is high. Wages are rising. Businesses are profitable. Households can absorb higher rates because their income is growing too. But that is not what happened here. Rates rose to fight inflation, but wages did not keep pace. Real income, adjusted for inflation, has been flat or declining for 2 years. So households are facing higher mortgage payments with the same or lower purchasing power. The squeeze is happening from both sides simultaneously, and that is the trap. Let me cut through the noise. What OSFI is telling you without saying it directly is that they expect a wave of financially healthy, creditworthy borrowers to default. Not because they are irresponsible, not because they made bad decisions, but because the math no longer works. A household that was fine at one point, 5% is underwater at 5%. The system repriced the debt, but did not reprice the income. And when that gap cannot be closed, the borrower walks away, not out of fraud, not out of negligence, out of pure arithmetic. And this is where the psychology becomes critical, because once the defaults start, once your neighbor walks away from their mortgage, once you see houses in your neighborhood going into foreclosure, the mental calculus changes for everyone. You start asking yourself, why am I killing myself to make this payment when I am underwater on the asset? Why am I draining my retirement savings to hold on to a house that is worth less than I owe? And if enough people ask that question at the same time, you do not get a slow burn of defaults. You get capitulation. You get people making the rational decision to walk away before the situation gets worse. And once that starts, the banks are not absorbing small, manageable losses. They are absorbing a flood. This is the moment the clock actually starts. OSFI is not locking up $60 billion because they think a few thousand households will struggle. They are locking it up because they see the potential for systemic stress. They see the potential for defaults to cluster, for fear to spread, for the psychology to shift from I must hold on to I need to get out. And when that shift happens, all the capital ratios and stress tests in the world will not matter. The only thing that will matter is whether the banks have enough cash to survive the wave without needing a government bailout. Now, you might be thinking, but the banks are saying everything is fine. They are reporting strong earnings. Their CEOs are saying the Canadian consumer is resilient. And you are right, they are saying that. So let me show you what they are actually doing, because actions speak louder than press releases. In the last 6 months, Canadian banks have quietly started tightening lending standards across the board, not officially, not in a way that shows up in a policy document. But if you are a mortgage broker, if you work in commercial lending, you have seen it. Appraisals are coming in lower. Debt service ratios are being calculated more conservatively. The approval process is taking longer. Deals that would have closed in July are getting kicked back in December. And when you ask why, the answer is always vague. Risk appetite, market conditions, portfolio optimization. But the real answer is simple. The banks are conserving capital. They are preparing for the same thing OSFI is preparing for. Here is the part they are not telling you. When a bank tightens lending, they are not just protecting themselves, they are accelerating the problem. Because the small business that needed a credit line to make payroll, they do not get it. They lay off workers instead. The homeowner who needed to refinance to consolidate debt, they get denied. They fall behind on multiple payments instead of one. The system that is supposed to provide liquidity during stress is doing the opposite. It is withdrawing liquidity. And that withdrawal is creating the very defaults the banks are afraid of. This is not a conspiracy. It is a stated policy hidden in the language of prudent risk management. And once you see it, you cannot unsee it. The regulator raises the buffer. The banks tighten lending. Borrowers lose access to credit. Defaults rise. The regulator points to the defaults and says, see, we were right to be cautious. And the cycle feeds itself. This is where the first domino falls. But here is what makes this moment genuinely unprecedented, because we are not just facing a mortgage crisis or a credit crisis, we are facing both at the same moment while the economy is already weak. Let me show you the convergence. Force number one, the capital buffer is at a record high, restricting the supply of money. Force number two, mortgage renewals are at a record high, creating massive demand for money. Force number three, the economy is stagnant, meaning household income is flat while costs are rising. Three forces hitting at once, all pointing in the same direction, and the direction is contraction. This is where common sense actually becomes your enemy. This is where common sense actually becomes your enemy, because your instinct is to assume that someone somewhere is going to step in and fix this. The government will announce a relief program. The Bank of Canada will cut rates. The banks will offer payment deferrals. Something will happen to prevent the worst case scenario, and maybe something will. But let me show you why the options are far more limited than they appear, and why the people in charge are already signaling that they cannot stop what is coming. Start with the Bank of Canada. The obvious move would be to cut interest rates aggressively, to bring mortgage rates back down and relieve the payment shock. But here is the constraint they are operating under: inflation. As of December 2025, inflation is still running above the 2% target. It has come down from the peak, but it is not fully controlled. If the Bank of Canada cuts rates too quickly, they risk reigniting inflation. Food prices start climbing again, energy costs spike, and suddenly the household that was struggling with a high mortgage payment is now also struggling with $12 milk and $2 per liter gasoline. They would be trading one crisis for another. The Bank of Canada knows this, which is why their recent statements have been so carefully worded. They are acknowledging the pain, but they are not promising relief. That should tell you everything. Now look at the federal government. Could they step in with a mortgage relief program, a payment subsidy, a refinancing backstop? Technically, yes. But here is the problem. The fiscal room to do that is vanishing in real time. Canada's federal debt is already sitting above $1.2 trillion. The deficit for this year is projected at $40 billion. And tax revenues are softening because the economy is slowing. If the government announces a major relief program, say $10 or $20 billion to help struggling mortgage holders, where does that money come from? More borrowing, which means more bond issuance, which means upward pressure on interest rates, which makes the mortgage problem worse, not better. It is a trap with no clean exit. Let me be precise about what that means. If the government tries to bail out households, they drive up the cost of borrowing for everyone, including themselves. If they do nothing, defaults rise and the banks take losses, which could trigger a credit freeze. Both paths lead to pain. The only question is who absorbs it, households or institutions. And based on OSFI's decision to protect the banks first, you can guess which path they have chosen. This is the detail even analysts tend to miss. The policy response is not unlimited. The tools that worked in 2008 or 2020, massive liquidity injections, emergency rate cuts, direct fiscal support, those tools were deployed when debt levels were lower and inflation was not a concern. In 2025, both of those constraints are active. The room to maneuver has shrunk dramatically, and the policymakers know it. That is why OSFI is preemptively locking up capital. They are not expecting a rescue. They are expecting a reckoning. Now let me show you what this looks like on the ground, because macro numbers become meaningless until you see the mechanism in action. Take a mid-sized Canadian city, call it anywhere, London, Ontario, Kelowna, BC, Red Deer, Alberta, does not matter. In that city, there are 20,000 mortgages up for renewal in Q2 2026. Let us say 15% of those borrowers, 3,000 households, cannot make the new payment, not because they are reckless, because the math does not work. They start missing payments in Q3. By Q4, 500 of them are officially in default. The banks begin foreclosure proceedings. Those homes hit the market in early 2027. But here is where everything changes, because those 500 homes are not selling into a strong market. They are selling into a market where buyers are terrified. Prices start dropping, not crash level drops, not yet, but steady declines. 5%, then 10. Suddenly, every homeowner in that city who bought in 2021 or 2022 is underwater. They owe more than the house is worth. And when they go to renew their own mortgage, the appraisal comes back low. The bank says, we cannot extend the same loan amount. You need to bring $20,000 to the table to make up the difference. Where is a household that is already stretched supposed to find $20,000 in cash? This is the crack that becomes an earthquake. Because once prices start falling, once homeowners realize they are trapped in a depreciating asset with rising payments, the psychology flips. Fear becomes the dominant variable. People stop thinking about holding on and start thinking about cutting losses. And if enough people try to cut losses at the same time, you do not get an orderly correction. You get a stampede, not because the fundamentals collapsed overnight, but because the collective belief in the stability of the system evaporated. And this part has already begun. You can see it in the data if you know where to look. Listings are up, sales are down, days on market are stretching out, prices are holding for now, but the volume is falling, and volume always leads price. The sellers are showing up, the buyers are disappearing, and the gap between them is widening every month. OSFI sees this, the banks see this. They are not reacting to a hypothetical. They are reacting to momentum that is already in motion. Let me show you the second crack, the one that connects this back to the broader economy, because it is not just housing. When mortgage payments spike, discretionary spending collapses. The data is unambiguous on this. A household that sees its housing costs rise by $900 a month does not just absorb that loss. They cut spending everywhere else. Restaurants see traffic drop. Retailers see sales decline. Service businesses see appointments cancel. And those businesses, the small and medium-sized enterprises that employ the majority of Canadians, they are operating on thin margins. A 10 or 15% drop in revenue is the difference between breaking even and going under. This is where the zoom in matters. Let us take a specific example. A family-owned restaurant in suburban Toronto. They have been in business for 12 years. They survived the pandemic. They are not poorly run, but in Q1 2026, they see a 20% drop in revenue. Customers are not coming in as often. When they do come, they are ordering less. The owner tries to adjust, cuts hours, reduces staff, stops ordering premium ingredients. But the fixed costs, rent, utilities, insurance, those do not go down. By May, they are burning through their line of credit. By July, the bank notifies them that the line is being reduced, not eliminated, just reduced due to portfolio rebalancing. Suddenly, they cannot make payroll. They close in August. 15 employees gone. Those 15 employees stop spending. The cascade continues. Now multiply that story by 10,000, 20,000, 50,000, because it is not one restaurant, it is thousands of small businesses across the country, all hitting the same wall at the same time, all losing revenue because households are diverting every available dollar to mortgage payments. And when those businesses fail, the commercial real estate they were renting becomes vacant. The landlord loses rent. The landlord has their own mortgage on that building. Defaults spread from residential to commercial. The contagion moves through the system like a shockwave. This is not theoretical, this is observable, and OSFI knows it. That is why the buffer is not just about mortgages, it is about the entire credit ecosystem. They are seeing stress in consumer credit, they are seeing stress in corporate credit, they are seeing stress in commercial real estate, and they are connecting the dots. All of those stress points trace back to the same source. Households are running out of money. And when households run out of money, everything that depends on household spending breaks. Here is the part that should terrify you. The system we built over the last 40 years is entirely dependent on continuous credit expansion, not occasional credit expansion. Continuous. Every year, more loans, more debt, more leverage. Because the economy is not growing fast enough to generate organic income growth. So we substitute debt for income. We borrow to maintain consumption. We borrow to buy houses. We borrow to start businesses. And as long as rates stay low, the system holds together. But the moment rates rise, the moment the cost of servicing that debt exceeds the income it generates, the whole structure becomes unstable. Let me cut through the noise. What OSFE is telling you with this decision is that the credit expansion has stopped. It has not just slowed, it has stopped. The banks are no longer in growth mode, they are in preservation mode. They are not looking for new borrowers. They are trying to protect themselves from the borrowers they already have. And when the credit engine shuts off, when the flow of new money into the system stops, every entity that was dependent on that flow starts to fail. Not might fail, starts to fail. The timeline is already set. Now, let me show you the only move that makes sense in this environment, because this is where we shift from diagnosis to decision. You have a choice to make. You can assume that the system will stabilize, that policymakers will find a way to thread the needle, that the defaults will be contained, and the banks will weather the storm without major disruption. That is one path. Or you can look at what the people with the most information, the regulators, the central bankers, the bank CEOs, are actually doing, not what they are saying, and adjust accordingly. What are they doing? They are hoarding cash. They are reducing exposure. They are building buffers. They are preparing for an environment where liquidity is scarce and volatility is high. And if that is what the insiders are doing, you should probably be doing the same thing, not because you are panicking, not because you are a pessimist, but because you are reading the signals correctly. Here is what that means in practical terms. If you have debt, especially variable rate debt, especially debt tied to discretionary assets, you need a plan. Can you refinance now before renewal? Can you lock in a rate? Can you reduce the principal? If you are sitting on equity in a home, this might be the last window to access it at reasonable terms before lending standards tighten further. I am not saying sell everything and run for the hills. I am saying understand that the environment is shifting and the time to adjust is before the crisis, not during it. If you have cash, if you have liquidity, protect it. This is not the environment to be reaching for yield. This is the environment to prioritize safety, because when the credit crunch arrives, when businesses are failing and assets are being liquidated, cash becomes the most valuable thing you can hold, not because cash is a great investment, because cash gives you optionality. It lets you wait. It lets you choose your moment. It lets you buy assets from people who are being forced to sell. The prepared do not get rich during the crisis. They get rich in the aftermath when everything is on sale and they are the only ones with capital. And if you are looking at the broader question of wealth preservation, understand this. We are entering a period where the value of paper assets, stocks, bonds, anything that is a claim on future cash flows is going to be tested, because those cash flows depend on a functioning economy, on stable credit markets, on predictable growth. If those assumptions break, if the credit system freezes and the economy contracts, the value of those claims evaporates. Not permanently, but during the stress period, the volatility will be extreme. The investors who survive are the ones who diversified into assets that do not depend on the financial system functioning smoothly. History favors the prepared. It favors the people who looked at the warning signs and took them seriously. It favors the people who understood that when the regulator locks up $60 billion, they are not doing it as a precaution. They are doing it because they see the math, and the math does not lie. The mortgage renewals are coming. The payment shock is arriving. The defaults are locked in. The only variable is whether you are positioned to weather the storm or whether you are caught exposed when it hits. Friends, the window for preparation is closing, not in years, not in months, in weeks. The decisions you make in Q1 2026 will determine how you emerge from Q4 2026. OSFI has made their decision. The banks have made theirs. The only question left is, what is yours?